Prices are slipping, listings are surging, and the big question on everyone's mind right now, if you're selling, did you miss the peak? Or if you're buying, are you doing it too soon? But first, I'm Dawn, and if you find any value in my videos, please like and subscribe. My goal this year is 1,000 subscribers, and I'm getting closer. Your support means a lot, so thank you. Let's get right into it today with April's sales. We saw 2,236 properties sold in Calgary, a drop of 22% year over year. Now, that sounds dramatic, but it's actually in line with long-term trends. But here's the thing. This isn't a demand collapse. According to Krebs' chief economist, Anne-Marie Lurie, economic uncertainty and higher lending rates slowed activity. Yes, but strong migration and stable employment have kept us from a major decline. I know I really felt like a lot of people were holding off, waiting to see what was going to happen with the tariffs and the election. And now that the election is over, I think we'll see an uptick in sales, almost like our spring market was delayed a bit. New listings jumped to 4,038 units, up nearly 16% from last year. That's brought inventory levels up to 5,867 homes on the market, double what we had this time last year. Compared to March, new listings were basically flat, just 19 more, but inventory rose by 713 homes. So what does that tell us? Supply is building and fast. Now, this surge has nudged the market into more balanced territory. More choice for buyers, less bidding war drama, well, kind of. But remember, this is still Calgary. Inventory is only now approaching typical April levels after years of undersupply. And this is key. Our months of supply is now at 2.62. That's a 177% increase over last April when we were in ultra tight seller's territory. But 2.62 months, that's still not a buyer's market. It's balance, with variance depending on price and property type, but actually still closer to a seller's market than a buyer's market. Not to say a buyer's market isn't on the way. Here's where I want to pause and tell you something important. When you hear these updates, sales down, inventory up, it's easy to think the entire market is slowing down evenly, but that's just not the case. In certain Calgary neighborhoods, especially for detached homes under 650,000, competition is still fierce. If you're shopping in that range, you might go in expecting deals, but find yourself in a bidding war. And speaking of, let's talk about prices, because this is where the headlines can really mislead you. You might have seen reports saying home prices in Calgary are plateaued or even falling. And technically, if we're talking about the overall benchmark price for all property types, yes, it's down slightly, sitting at $591,100, which is a 1.4% drop from last April, a modest adjustment, not a crash yet. If we look at the map of districts in Calgary, we can see that the total residential benchmark price is down year over year for the whole city, with the exception of the south, where we see the ever so slightest gain of 0.2% year over year. We saw the biggest year over year drop across the city in the north, where the northeast and the city center are just slightly behind them. Now, when you break it down by property type, the picture shifts. Detached homes, still climbing. The benchmark price is now at $769,300, up 2.41% year over year, but essentially flat month over month. Semi-detached, up even more, $691,700, a 3.6% gain from April last year. Row homes more stable, up just 0.5%, sitting at $457,400, and apartment condos basically flat, $336,000, up a hair at 0.1%. All of these segments and prices have essentially plateaued from last month. Now, zooming out, I always think it's important to take a broader look at economic factors that could influence our market here in Calgary. Not just where we are today, but where we're headed. Let's talk about the bigger picture, the national signals, the risks, and how they could show up right here in our city. The Bank of Canada's latest financial stability report just dropped, and while there's a lot in there, a few key concerns really stand out. Trade tensions are heating up. The bank flagged escalating trade conflict with the US as the top threat to Canada's financial system. This might sound like something for Ottawa to worry about, but here in Alberta, where the energy sector drives jobs, wages, and migration, If tariffs stick around or grow, we could see slowdowns in energy exports, which would hit jobs and by extension, housing demand. We're not seeing this yet in the numbers, but it's something I'm keeping a close eye on. Financial stress is growing. Interestingly, even though Canada's household debt to income ratio has improved, the report shows more Canadians are falling behind on car loans and credit cards, especially households without mortgages. This tells us something really important. People's everyday budgets are stretched, even before they think about even buying a home. If you bought your home during the pandemic at record low rates, your mortgage may be up for renewal soon. And even though today's rates are slightly lower than last year, they're still higher than what many homeowners originally locked in at. So for some households, this could mean $200 to $600 more a month, a big jump if you're not ready for it. This report also highlights that during housing booms, investor demand intensifies price growth. And in Calgary, we've seen more investor interest in the under $700,000 segment. That could lead to tighter competition for first-time buyers and continued pressure on affordability, even as the broader market stabilizes. Now, let's talk employment because it's propping up this market more than people realize. After a quiet winter, Alberta added 15,000 jobs in April, a 0.6% gain, making it one of the top performing provinces in Canada. That growth reversed March's dip and pushed total employment to 2.566 million. Despite the gains, Alberta's unemployment rate held steady at 7.1%. That's not bad, it just means new jobs were matched by new job seekers, many of them newcomers to Alberta. Here's where the jobs came from. Public sector gains from the federal election finance and real estate growth in Calgary and Edmonton, construction activity ramping up to meet housing demand, healthcare expansion to serve a growing population, even with some spots left in energy and manufacturing. Alberta's labor market is holding strong, and that's keeping housing demand surprisingly resilient even with higher rates. Quick pause. If you're still with me, hit that like button. It tells YouTube you want to see more about the Calgary real estate market, and it helps me reach more amazing people like you. In real estate, leading indicators are measures that provide early signals about the future direction of the market, while lagging indicators are measures that confirm trends after changes have occurred. Some leading indicators on how our housing market could perform would be building permits and housing starts, which remain high. In Calgary, housing starts experienced a noticeable surge in the first quarter of 2025, with a 16% increase compared to the same period in 2024, especially in multifamily. That tells us more supply is coming, but not instantly. It'll be a 6 to 18 month lead time. Another indicator is mortgage applications. Overall, the outlook for mortgage applications in Calgary in 2025 is positive, with the potential for increased activity and lower borrowing costs for homeowners. However, economic uncertainty and high home prices remain potential challenges for the market. Consumer sentiment in Alberta remains, I think, cautiously optimistic. Strong job growth and oil sector stability are keeping buyer confidence up. Interest rates, we know the bank held their last interest rate announcement. You can check out my video here where I discuss that in more detail and give you an indication as to why and what they might be doing next. Lagging indicators are sales, price data, inventory, and days on market. Vacancy rates in Calgary's rental market rose to around 4.8%, softening rents and reducing urgency for some renters to buy. Put simply, the signals ahead are pointing towards a more balanced market, especially as more listings hit and new builds complete. But that shift is uneven. Detached homes are in the mid-range, are still moving fast, while apartments and higher-end homes are softening first. As we continue this discussion about our market and what affects how it moves, we need to discuss how Calgary's economic health and housing market have long been intertwined with the oil and gas industry. When oil prices soar, the city experiences job growth, wage increases, population influx, and conversely, downturns in oil prices have historically led to job losses, decreased wages, and housing market slowdown. Recent developments in the international trade, particularly involving the US tariffs, could have significant implications on the energy sector. This could reduce Alberta's energy exports, potentially leading to decreased revenues and job losses in the sector. Prolonged trade disputes and potential downturns in the energy sector could lead to slowed economic growth, affecting housing demand and price appreciation. It's a tale of two markets right now. One where well-priced detached homes are still hot, and another where apartments are seeing price resistance and longer days on market. So whether you're buying, selling, or investing, know your segment. Calgary's market is too diverse to paint with one brush, and as always, the key to navigating any shift is understanding both the data and the signals. If you found this video helpful, please like and subscribe. If you have any questions, feel free to reach out at the link below. Thanks for watching, and I'll see you soon.